The current demand for uranium is only going to go up from here. It's going to go up by a few percentage points a year. At the same time, a lot of the best mines in the world have been on care and maintenance up until the last 12 months. So there's starting to be a supply response in the market in terms of higher prices are incenting mines to come back online. But we're far from kind of filling the big supply deficit that we think is growing in the sector as more and more nuclear power plants come online over the next decade or two.
I'd like to start with a discussion on the inflationary environment that we are amidst. Do you find reasons to expect inflation to be linked to this energy transition over the coming decade?
Yes, very much so. I think investors are starting to take notice of this, and we see signals all around the world with respect to the capital intensity of the transition is going to, require significant investment over the coming decades. And this is going to put pressure on local supply chains. This is going to put pressure on raw material prices, the demand for labor. And I think for context, it's important to note that in a lot of these capital-intensive industries, such as mining, they've largely been underinvested in for the greater part of the last 10 to 12 years. So when you have a sector that's been starved of capital for as long as it has been, and then all of a sudden you have a demand shock, you see the instant ramifications of that. So we talk to mining companies, whether they're in the precious metal sector or whether they're mining for nickel or copper, they're all facing similar issues, which is shortages of materials and particular labor in some markets. So we do think that this wonderful period of globalization and free trade that we've enjoyed for the greater part of the last 3 years has brought tremendous disinflationary benefits, as our model was basically largely predicated on capital going to the lowest cost center in the world. A lot of those low cost centers obviously were in places like China. And now with energy policy, industrial policy shifting, we see a very dramatic shift happening with respect to building onshore supply chains in a number of key areas. And these supply chains, like it or not, are going to be more expensive than the supply chains that exist in lower cost jurisdictions like China. So we think this is going to create profound impact.
John, if we look at the capex in this sector, how severe is the underinvestment in your view?
Yeah, well, I always talk about a sector that has gone through a 10-year bear market. And in that 10-year bear market, there was very little investor interest in it. The returns were not very good. The commodity prices were flat. And there were abundant other opportunities for investors in an era of very low cost money. And so, the technology sector was obviously a gigantic winner over that period of time. And then you have the added kind of negative halo of ESG and people's reluctance to invest in mining. And, then you fast forward in the last 2 years, and COVID obviously opened our eyes to some of the weaknesses of just-in-time supply chains, foreign supply chains, and then obviously more recently in the last 12 months, the shock of having Russia invade Ukraine and really highlighting to the world how vulnerable our energy systems are. And that when you basically outsource many of these services and industries to nations that one day are operating on a friendly basis and then the next are not, all of a sudden gets people very concerned about how resilient their own economies are. If you are basically at the mercy of these aggressive nations and or weak supply chains. So it's been a profound, I think, shift, and we've seen a real wake-up call for governments around the world with respect to energy transition as well as energy security.
One of the commodities that we will need for this energy transition is copper in size. And one of the things I grew up with, John, was a sort of a constant fear of running out of natural resources in energy space. The fear of running out of oil was something that we discussed through the 80s and 90s and into the zeros. So do you see any resemblance to that discussion on energy now that we need copper, for example, in size over the coming decades?
Yeah, I think we are dealing with a situation where you've got kind of a perfect storm with respect to a demand shock and a supply shock happening at the same time for many of these critical minerals related to energy transition. So you've got a supply shock because you've had years of underinvestment. Capital did not fund the exploration and development of projects, greenfield projects, for many, many years. And that came, at the same time you've seen a demand shock. So as economies are reopening and we've seen a big transition to renewable energy, electric vehicles, more of electrification, or the intention to electrify more, all of a sudden you've got this demand shock. So we do feel like we are in a period right now where it's not just copper that's going through this period. Lithium is another commodity that has gone through this dual shock of energy, demand and supply shock at the same time. And I think it's amazing to us to watch how this is playing out in the investment market. You're starting to see OEMs, the car makers, starting to make vertical integration investments along the lithium and copper supply chains, because they are very concerned about having enough raw materials in order to achieve their goals, which, some of the car companies are saying we want to have 50% of our new car sales to be EVs by 2035, for example. And, just in the last few weeks, we've seen a number of car companies make investments in lithium mines that they're being developed. For example, General Motors invested in a company called Lithium Americas. We just last week heard about Stellantis buying or investing in a copper mine that's being developed by McEwen Copper in Argentina. And, for us as longtime investors in mining and metals, this is quite profound to us when OEMs are making equity investments in mining companies at kind of a pre-development or in a development stage. Really tells you how concerned they are about having abundant supplies of raw materials in order to implement these big strategic shifts that they're putting into place. And then, what is also driving a lot of this is obviously government incentives. The Inflation Reduction Act, which is probably going to have the absolute opposite effect. Will probably create inflation. They're dangling $369 billion of different incentives, specifically at clean, and everything to do with clean energy, whether that's wind, solar, nuclear energy, hydrogen, charging stations, you name it. They're throwing basically hundreds of billions of dollars, and it's really about building onshore supply chains. This is what this piece of legislation is all about. I think the U.S. government, as well as other governments, are very concerned about being beholden to China for key supply chains like batteries for EVs, which China dominates. They obviously dominate things like rare earth production, which are also another critical and set of minerals for not just energy security, but also national defense. So governments are finally, I think, shifting their industrial policy. And it's been a big shift because, as I said earlier, our model in the world since the fall of communism has largely been on globalization and free trade. Now the governments are basically sending very powerful investment signals to the private sector saying, hey, we want this to happen. We want these investments to happen. We're going to crowd you into these investments by dangling all these incentives. We're going to de-risk these investments for you so you have more predictable rates of return so that the capital from the private sector will come with the help of the public sector. And this is happening in critical minerals. It's happening in battery metals. It's obviously happening in semiconductors and pharmaceuticals. And we think it's a pretty profound shift that's going on right now. We also see a number of strategic alliances being formed around battery metals amongst countries in the West that are very concerned about building local supply chains. And there's also the element of reshoring and creating local jobs. If you look at the Inflation Reduction Act, to qualify, for example, for the full amount of the EV tax credits, you have to have a fairly high percentage of the components of the batteries in the cars built and sourced and processed in the United States. So, instead of, investing in China or Europe to build a gigafactory, all of a sudden car companies are going to be like, maybe we should be building them in America because there's also cheap energy there. And it's actually created a little bit of trade tension with the EU. of late. So we think what's happening right now is quite profound in the critical minerals and energy transition sectors.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.